Hi, Alan Stratton here from CostMatters.com. In a recent forum, a member posted the following question. Absorption costing may not be the best approach for product costing. For example, why isn't a cost of capital or return on assets incorporated into costing rates? Now, this question may be somewhat technical, but it begs for refining the question and separating some issues. First, let's define absorption costing. The classical definition is that absorption costing are the direct costs of manufacturing plus the indirect costs of manufacturing. Begs the question, what are direct costs? Direct costs are typically the material, labor, and some other costs that can be directly related to the product. So that leaves indirect costs. What about them? One could say that indirect costs are all other costs other than the direct costs, but that definition would be much too vague. More specifically to absorption costing, indirect costs are the remaining manufacturing, specifically manufacturing costs. Manufacturing costs would typically relate only to the production environment and specifically before the product is placed into finished goods inventory. It typically does not include any costs incurred after manufacturing. Absorption cost can be compared to variable costing. Variable costing, as a practice, only includes the direct costs of manufacturing and charges all others to the profit and loss. Now, generally accepted accounting principles, or generally called GAAP, are used for external reporting and taxation. Here's the problem. Generally, GAAP would only inventory the manufacturing absorption cost. Why not just the variable cost? It may make sense. There are some great arguments for variable costing. One argument is that the absorbing of overhead encourages building finished goods and/or work in process inventory that may not be needed for actual sales. In other words, it may be a waste. However, variable cost is not GAAP compliant, doesn't qualify for external reporting, and therefore cannot be used except for external reporting or taxation. Now, just to explore taxation, for taxation, a variable cost approach would actually lower taxable income when inventory is increasing. So, in the eyes of revenue officials, lower taxable income means less tax revenue. Here's the rub. So the bottom line is that tax regulations encourage putting cost into inventory, thus deferring it when it can be deducted from revenue. Now, up to this point, these definitions primarily address the needs of cost for external reporting and taxation. What we need to understand and to manage our modern businesses often requires a broader view of costs, because in most modern businesses, a significant portion of business expenses or costs are incurred after manufacturing and therefore would not be included in the classical product cost, but yet they are costs. In addition, manufacturing often is only a smaller proportion of total cost than it has been historically. Significant costs are required to sell to and to serve customers. Now, understanding these customer-related costs is a new and separate dimension, another question almost altogether. This dimension is separate but related to product costs. We need to consider them together. Another large category of modern business cost is the cost to sustain its infrastructure and management processes. Now, these sustaining costs do not relate directly to either the cost of manufacture or the cost to distribute products or to cost to serve customers. So for management purposes, we may also choose to include the cost of capital, yet another category of cost, and relate this cost to products, customers, or to business infrastructure. If we were to do this, we should follow good cause and effect costing principles and avoid broad brush allocations, just as we should do in assigning all other overhead expenses. So, whether absorption costing is the best approach for product costing? It depends on how the information will be used. My specific recommendation would have to adapt to the specific goals and needs of the business. But in general, looking at a product cost that spans more of the fulfillment cycle is much better. This cost could include cost of capital if it's significant. A separate but related cost would analyze customer-related costs and business-sustaining costs. Now, this is a somewhat complex question and definitions. I'd appreciate it if you could share your examples in the space below. Here's to your business profitability. This is Alan Stratton from CostMatters.com. Thank you.